Thanks for tuning into the Alternative Bets. I'm Neeraj Shah, and we are continuing our conversation with the management of Neo Group around the different alternative aspects that are there. The previous two episodes have told you about what quantum of alternative investment opportunities exists for an Indian investor, some of which even I didn't know. The second episode talked about the private credit opportunity in India, and it is taken off maybe around the 5-6 years, but now it's really picking up steam. Now, a lot of us have seen headlines over the past 15-20 years of global investment banks or global banks buying stakes in India infrastructure projects. And while infrastructure, to your and my mind, loosely is attached with companies which are listed on the Indian bourses and give you an opportunity to participate in the equity value of infrastructure, there is an alternative way to participate as well. And that is what we try and talk to two key people from the Neo Group this time around about the infrastructure opportunity. They obviously have a product around this, and we would love to know more about that as well. So Hemant Daga, co-founder of the Neo Group, and Abhishek Goel, MD and head of the Infrastructure Asset Management Fund in Neo, join us right now. Gentlemen, thank you so much for taking the time.
Thank you, Neeraj. Our pleasure equally.
Yeah, no, it's a pleasure being here in your office. Let's start off, Hemant, with just busting the myths around infrastructure investment opportunity in India. And what do you guys mean when you say people can participate in the infrastructure opportunity?
So interesting question, Neeraj. When investors look at any asset class for investing, for that matter, when I'm looking for any asset class for investing, what am I looking at? I'm looking at an asset class which is for the long term, which is giving me regular cash flows, compounds the cash flows. There is a high degree of predictability to the cash flows because that means you can sleep peacefully at night. And there is some inflation protection to the cash flows, right? So typically, if you can park your money in an instrument which meets all these characteristics, relatively safe cash flows, predictable, long term, as an investor, I would be very tempted to explore that investment opportunity, right? Infrastructure investing, in our mind, meets all these requirements. And what do we mean by infrastructure investing? Typically, investors in India have invested, as you rightly said, by owning equity of companies listed on infrastructure, right? But there are funds which own assets, fully operational assets, okay? So we are not taking any construction risk. We are not taking any execution risk. These are projects which are fully executed. They are throwing cash flows. Where are the cash flows coming? Largely from the center and the state counterparties. So there is predictability of cash flows. And that's an asset class. If I as an investor can access those cash flows, it's like saying there is a road project for the next 15 years, fully commissioned. The cash flows of that road project will come from NHAI. I can package those cash flows and give that to our investors. And that is how investors can benefit from these projects, because then they will be able to make returns based on those cash flows. And that's what we call as infrastructure investing. We want to invest in fully operational assets, no construction risk, long-term cash flows, regulated cash flows, and some inflation protection, and offer this as a product to our investors.
Okay. I'll get into that with Abhishek as well, but just a quick follow-up. So is that the one meaty option out there, or are there other options too out there for people to just get an awareness or an idea of what are the non-listed stock market infrastructure investment options, Hemant?
So firstly, Abhishek, I think in the last 15 years, these markets have evolved considerably. Okay. And there are multiple ways to play infrastructure investing. The easiest, but probably the most opaque, is to invest through equities of listed companies, right? Because along with projects, you're also getting the risks associated with the company, right? The second way is to own these assets. And how can you own these assets? There are two ways. There are funds, so you can subscribe to funds managed by people like us, asset managers like us. Globally, this is a very, very popular method, right? Just one interesting statistic I want to share with all viewers here. Globally, 45% of operating infrastructure assets, 45% of the world's operating infra assets are owned by pension funds and insurance companies. That number in India is just a measly 4 to 5%. Okay, so how can you own these assets as an investor? You can participate in funds managed by asset management companies. The third way, which is already happening in Indian markets, which is a listed instrument again, is what we call InvITs, right? Infrastructure Investment Trusts. And there are several infrastructure investment trusts listed in the market. Those also own assets. So an investor can play it through a listed equity company, which is not the ideal way because you're playing some other risk along with it. You can play through funds like us, which purely package all of these investments together, and whatever cash flows come, we give them to our investors. Or the third way is to play them through InvITs, which are far more seasoned projects where the returns will be slightly lower than what we would deliver as funds, but probably the same nature of returns.
Got it. Okay. Viewers, keep in mind that when Hemant is talking about the listed play way not being the ideal way to play it, he's talking about investors who want the predictable cash flows. If you understand the infra cycle really well, and if you can have the gumption of digesting the risk that an equity listed stock in an infrastructure company brings to the table, by all means, that is a way to participate, but it's not essentially participation in the infrastructure project, but in the equity value that a company which dabbles in infrastructure brings to the table. I hope that is the right way to put it.
Absolutely. And when a company is dabbling in infrastructure, it is dabbling in under construction projects, fully completed projects, right?
Yeah.
As asset managers, when we are dabbling in infrastructure, and Abhishek can spend a little bit more time on that, we are dabbling in fully completed projects, right? Operational projects. So the predictability of cash flows, the risk goes down, but the predictability goes up. And as an investor, as I said in the beginning, I would love to get access to these cash flows, Neeraj.
Yeah.
Right? Where your counterparty is the government of India, these are long-term contracts, and we are packaging these cash flows and giving to our investors.
Got it. So Abhishek, explain to us, and by the way, great having you on the show.
Thank you for having me.
No, the pleasure is ours. Let's explain this product, if you can, that you guys bring to the table. What are the kind of projects? Hemant gave us a brief inkling. Dwell a bit more into this, and how does a typical investor make returns from something like this?
Sure. So Neeraj, the thing is that let's think about infrastructure, right? When the infrastructure comes to mind, people have had experience investing in infrastructure, mainly into EPC contractors who are listed on the exchange. Okay, so there the business is to get projects or get orders, execute those orders, and get money from their clients, who can be government or whoever. We are talking infrastructure of operating projects. So in this project, the execution risk is not there. Only operating risk is there. And it's fairly easy to understand that the operating risk of an infrastructure project is fairly low, right?
Why so?
Sure. So mainly infrastructure projects, the characteristic is that execution risk is high, holding period is long, and the risk is low. For example, consider a road, okay? A road concession. Now, a road concession, typically the orders that are coming out from NHAI or state PWDs today, the cash flows are guaranteed by the government. So as long as you maintain the road properly, you will get a cash. And that cash is absolutely predictable, contracted for 15 years. On that, you can get your debt, and whatever is your capital left, that can be distributed to the investor. Civil maintenance is all that a infrastructure owner has to manage, which is fairly easy. An operating road, you have to make sure that you are meeting the constraints and making sure that the road roughness and deflection, etc., are okay. A renewable power plant, for example, a solar power plant has no moving part. They're all fixed. All you have to do is make sure that the assets are kept clean. There's no dust deposition, etc., and the regular electrical maintenance that you have to do, which is not a rocket science, as let's say compared to a coal-fired power plant, where you have to figure out where the coal is coming from. There is a turbine which is rotating at high speeds. There is steam management, there is environmental issues, etc. Those kind of things are not there.
But that is also an infrastructure asset.
That's also an infrastructure, yes. So somebody who wants to go for higher returns may want to take this risk and go for that. But somebody, we are of that category at least, that we don't like to take unnecessary risks. So we would like to focus our energies on roads, renewables, maybe some little bit of logistics, etc. But absolutely being clear that what risk we will take, what risk we will not take. And that is exactly what our advice to investors would be, that one has to be clear about what risk to take. like you were rightly pointing out, somebody might be very happy taking construction risks, for whom listed equities are the best way to play. Of course, they'll get much higher returns in that. But somebody who is wanting a long-term cash flow, predictable, want to be inflation protected. They are kind of worried about keeping the principal protected.
Sure.
For them, you have to focus on what we are talking about, infrastructure play. Right?
Got it. Abhishek, a follow-up. Not all infrastructure, I'm just trying to understand, would all infrastructure projects be backstopped by government cash flows, or in certain cases there are consumers involved, vendors involved? If it's a toll project, then the quantum of people who pass, etc., so on and so forth. So give us a sense of the relative levels of predictability of different projects, and maybe you pick and choose out of those only the ones which are the most predictable. So try and make us understand that also.
So what is the one characteristic that infrastructure projects enjoy? That characteristic is monopoly. Now, if you want to go from one city to the other, there is a road. Whether you like it or not, you can go on that road.
Most cases, yes.
Most cases. Or you may have some alternate cases as well. If you, for example, if you have to fly out of Delhi or Mumbai, there's one airport. I mean, there's another airport coming up. But effectively, you get the point, right? That the monopolistic nature of an asset is one big characteristic. The other big characteristic, there's a large capital intensive nature. Right? If somebody else wants to come and compete, they will have to put up a similar amount of capital in that. Rather than that, they'll go and build their project elsewhere. So the exclusivity of cash flows comes not only from contract with government, but also from monopolistic nature and a high entry barrier in terms of capital deployed. Right? Which has its own benefits, right? If there is a high entry barrier, nobody else can come. You may not have a long-term contract, but people, customers and vendors, etc., if they want to deal with you, they have no option but to go with you.
Sure.
And it is for this reason why infrastructure is heavily regulated as well. Because it's a monopoly,
Sure.
Government wants to ensure that you're playing it fair. And that's how infrastructure works globally. So that's what I would like to say about that.
And if I can just add, Neeraj, coming back to your question, conceptually, there are two types of infrastructure projects. There are availability-based projects, and I'll speak about it, and there are volume-based projects. Now, a road or a renewable plant or a transmission line, these are infrastructures, right? Now, by availability-based projects, what do we mean? Basically, if the road is made available subject to quality, if the transmission line is made available subject to quality, if the renewable plant is made available subject to quality, as an investor, you will get your cash flows. So when somebody is starting his journey in infrastructure investing, the kind of funds we want to do are more availability-based projects, right? Coming to your point on what type of projects are there. Then there are volume-based infrastructure projects, right? Thermal plant, which is far more linked to production, how you can source coal, how your vendors will offtake, right? Maybe a logistics unit, which is far more linked to how offtake will happen, right? So those are more volume-based, slightly more variable infrastructure projects. But once again, fully completed, but more volume linked, right? So as an investor, when you're looking at infrastructure projects, in your mind, we can clearly segregate the world as availability-based projects and volume-based projects. And as asset managers, even in our journey as we begin, and also as investors want to begin, I think availability-based projects gives even more stability.
Obviously, right.
Because that's even more safer in that sense. You're just making the asset available, the asset will yield returns.
Got it. So here's the question then, therefore, to both of you, within this bucket as well, and thanks for making bifurcation, would the availability-based projects have relatively lower but predictable yields versus a volume-based? And do you believe that in certain cases, a volume-based infrastructure project as well might be something that you might also want to partake in because the project or the promise of that product or that asset looks very promising?
No, absolutely. So what you're saying is right, that an availability-based project, right, there the risk is even lower. What you have to control is pretty much in your hands, right? You decide how well you want to maintain your plant and how much you want to spend and what kind of manpower is required. As long as the asset is well maintained, you get your cash flows, right? It's very difficult to not being able to maintain a infrastructure project given that they are fairly simple assets to manage. Having said that, a volume-based project does have ability to kick up that high, a little bit higher returns, right? Because you're taking higher risk. It's very linear, right? Risk and return is very linear. When the risk rises, return rises.
Right.
So that way it's a bit higher. A perfect infrastructure investment would be where you have a mix of both.
Okay.
Right? You got a set of assets which are availability based, you get a certain return fixed, right? Cash flows are predictable. There's hardly anything you can do which will destroy it, right? And there is a volume which is giving the slightly more kicker at a controlled risk, right? Volume, we're not saying go and invest into a greenfield airport,
Sure.
right, where the volume risk is
Yeah,
not
yeah.
determined. But let's say a road, having 10 years of operating history, right? You have seen 10 years of traffic, how it's growing, what kind of traffic components are there, where are people coming and going. That's a risk that can be taken for that extra return.
Got it.
So a perfect diversified mix of such projects would be the ideal portfolio in my view.
Got it. Now, Abhishek, please explain the intricacies or the aspects of a fund which would invest in such a thing, and investors, how do they partake in that opportunity?
So effectively what we are saying is that the fund is acting like a bridge between investment options, which is these projects, and investors who have capital to put into these projects. That's what the fund is doing, right? Like Hemant was saying earlier, this has been done extremely successfully globally. Like globally, 45% of global infrastructure is held by financial investors. And financial investors, more often than not, are passive investors. They don't know how to handle an airport, for example.
Of
right?
course.
So that's where the fund manager comes in. And similarly in India, that's what in India fund managers or infrastructure fund managers are trying to do. You got a set of assets. Now, government has been really pushing the infrastructure agenda, right? A number of assets are becoming operational and coming into the fold, where the guys who develop the projects want to take the money out of these projects and develop new projects. And rightfully so, because that's what the country needs as well.
Sure.
You need guys who have the execution experience
Yeah.
to be able to have this capitals to build new projects. That's what the country needs. That's what those developers need. That's what those investors or the developers need. But once a project is done, then the cash from these investors has to flow into those projects. And that's what the fund managers will do. So we will raise a fund, let's say X crores, approach some number of domestic investors, pool up their capital, and SEBI has a AIF structure that allows this kind of thing to happen. And that capital will be used to procure these operating assets, which have the predictable cash flows that we are talking about.
Okay.
And once those projects are taken into the fold, the capital is free for the developer to build new projects. Investors get access to the cash flow. And there's where the story flows.
And then the annual cash flows or the yields that
Yeah.
come in from these projects
Absolutely.
get returned back, distributed. So is it an annual thing? What is the life cycle of something like this? Can you talk
So
about
the
it?
way this works, Neeraj, typically these funds by nature are slightly longer duration, okay? Because the assets are longer duration, and that's how it should be. So these funds would typically be 7 years, 8 years in maturity. That's a good thing for investors because you can park your money into a stable asset for a long period of time, right? Now, how do returns come? The way returns are broken in these funds are twofolds. One, annual regular cash flows. So there is an annual yield, which is typically in the range of 7 to 9%. So every year, on a semi-annual basis, the investor gets a certain amount of cash flows in his pocket, right? Now, the total returns that an investor will make will be close to 16 to 18% on these assets, right? Now, 16 to 18%, approximately half of that will be in the nature of regular semi-annual cash flows, and the balance will be in the form of capital gains, which will be more back-ended. So when we buy these assets today, right, this asset is 30 years, right, because it's a road asset, 30 years. Our fund life is how much? 7, 8 years. After 7-8 years, we will sell this asset to somebody. At the point when we sell this asset to another buyer, and if it's a listed InvIT, then we will sell it at a slightly better price, correct? Because time value of money has also got added to it. At that time, we will also make a capital gain on that, which is why investor total returns will be 16 to 18%. So it's a very unique strategy. It's like a debt with a equity upside. So you're getting regular cash flows, which helps investors and de-risks investors, 8 to 9% annual and 16 to 18% total returns.
Okay. Yeah. So the annual cash flows may be whatever percent, let's say between 8 to 10%. And when you make this capital gains, you believe that the actual total life cycle return of the investment could be as high as 15-16%.
16 to 18%.
16 to 18%. So that's the kind of uptick that comes into the...
Absolutely. And these returns have been delivered. I think India as a market. So in the last 10 years, Neeraj, the interesting thing is there have been so many global funds operating in India. And these funds like Brookfield, KKR, Actis, GIP, they have seen global markets. They've participated in Indian markets. You know, Indian investors unfortunately haven't participated in this opportunity in a big way. These global funds have generated 20-25% compounded returns through multiple exits in the last 10 years. And that is the opportunity we want to showcase to domestic investors. I keep talking like equity. There are multiple asset classes in India, which is why, I mean, this entire show we've done, right? Alternative bets. There is private credit, which is a large asset class. It's probably as big as equities, right? There is infrastructure investing, which is as large as equities. And Indian investors need to slowly get exposed to these multiple facets.
Most certainly. Now, before I come to the risk is attached, Hemant, and I would want to take that piece with you. Abhishek, just a word about how does this happen? So it's an AIF structure, I believe, and therefore an investor has to put in a minimum 1 CR, and there is an annual payment paid back. The tax implications of this and versus the final payment, the tax implications are the same. And did I hear you guys say that the life cycle of these kind of funds that you are bringing is typically 7 to 8 years?
That's absolutely right. Yeah. So the AIF would have a 7 to 8 year life cycle, right? And as Hemant mentioned, there are two ways to give cash back to the investors. So let's say an investor has put 100 rupees in the fund. Now they will get anywhere between 7, 8, 9 rupees every year in 2 installments. So 3 to 4 rupees in 6 months, and then following 3 to 4 rupees. This will come to them as a mix of dividend and interest. Now, because of the current tax laws, dividend and interest are taxed on a full marginal rate. So that will come to them, and this will keep growing as the years go by, because a cash flow from an infrastructure project is always growing. At the end of or near the end of the infrastructure fund, the fund manager will decide to sell the asset. Now the asset has a very long life, right? So the asset still makes sense for, let's say an InvIT or some strategic players or some pension funds. It makes a lot of sense for them. So you can always flip or sell those assets to such buyers and get a capital gains. On that capital gains, you get a long-term capital gain, which is somewhere around 20-22%. And that is also on indexation. So the initial price of 100 rupees at which was invested will grow at inflation. And then the profit will be calculated basis the grown investment amount and the exit amount. And on that, you have to pay 22%. So it's a bit more tax efficient than a simple dividend which people are used to getting from equity.
So typically I'm sure you've done the math. What does the typical tax therefore come to? It won't be 30%, it will be 13 to 15% kind of halves because of the benefit of indexation. Okay.
Absolutely.
Now, Hemant.
So just to finish the point, Neeraj, I think on a blended basis, effectively taxation works out to, obviously based on different investors, it works out to approximately 22 to 23%. I mean, the range can be broader, maybe 22 to 25%, but that's the blended taxation.
That's for individual investors. Now, if companies are investing, then the tax rate is 25% as well.
Got it. Okay. Now, the question in minds of a lot of people, right? People cite the previous capex cycle, the previous infra cycle, and how a lot of people lost fair degree of money at that point of time. Global investors as well who came into infrastructure projects, infra investing. Is this cycle different, Hemant? Why should people trust that there will be certainty around capital return of capital and return on capital and return of capital. Let's put it that way.
So this is a beautiful question. Herein lies the heart of the opportunity. Okay. And it's going to be a slightly lengthy answer. There are two parts to this. Is the cycle different? So yes and no. So firstly, why yes? Why is this cycle different? So firstly, infrastructure as an asset class has evolved considerably in India. If you look at the government, I think the way the government is putting an impetus on infrastructure spending, you look at the budgeted numbers on infrastructure spending, I think there is a thrust on infrastructure and there is a thrust on monetization. When you listen to the government also wants to monetize infrastructure projects. You hear about the government wanting to monetize, right, to meet its disinvestment targets. So that has fundamentally changed. I think regulations have become far more stable. Investors have had a great experience, financial investors, right? And why? So fundamentally, many asset classes change over 15 years. And investors who appreciate this, who want to embrace some of these newer opportunities, right? So if you look at the world of private equity, in India, in 20 years, has that changed? It's changed considerably. You look at the world of public market equity, changed considerably, right? It's become even better. Governance standards have gone up significantly. Similarly, infrastructure, I think the regulations, the laws, the way the government wants to push, I think a lot has changed. And some things have yet not changed, right? Some things were right even then. They were probably not managed well. As financial investors, we manage them well. What do I mean by this, Neeraj? See, when a developer builds a project, a developer is typically short of capital, right? What is a developer doing? He's trying to build the project by taking leverage. And then he takes more leverage. So basically, his financial balance sheet actually bloats up compared to the opportunity. Margins are relatively lower. Balance sheet goes up because he's taking more. He doesn't have capital, right? Infrastructure, as Abhishek said, is capital intensive. Now, when he has taken leverage, there is a cost overrun, there is some delay. That means his balance sheet starts getting impacted. When his balance sheet gets impacted, he has to sell these projects at a loss. He doesn't complete these projects. That's why, we always hear, कोई भी project time पे खत्म नहीं होता है, right? Because his balance sheet has actually impacted the project. The project has not impacted the balance sheet. In financial investing, leverage and how a balance sheet plays impacts returns. It is like equity markets. I can afford to buy only 50 rupees of a stock. I go and buy 200 rupees. The stock is good. The end outcome is good. But because I bought 200, the stock went down sometimes in between. I had to get out at a loss. The same thing applied to those developers, right? Now, what has happened? Now these developers have realized we are short of equity. Our capability is build the project. Who has equity? Asset managers. These are the people who should put money into these projects, right? Because where are we getting money? We are getting money from end customers, right? So they have also become smart. They have learned in this 15-year cycle, let us stick to our core skill. We will build the project. We will hand it over to asset managers. What are asset managers doing? We are buying these assets, running them efficiently, taking optimum leverage, and delivering returns to our investors.
Got it. So there's a lot more certainty this time around.
There is a lot more certainty because the business model has changed. As custodians of customer money, we are in the business in a fiduciary relationship. The customer is giving me money to buy long-term assets. We are buying those long-term assets, maintaining them well, and giving the cash flows back. We are not in the business of optimizing other things on the balance sheet to increase returns.
Got it. Yeah. A clear demarcation. Great. Okay, guys, any hygiene points that we've missed in this conversation? Because I think I've covered most of the things, including risk, but is there something else that...
I would like to mention one point, and basically my thought was arised by what Hemant said. See, what has changed in the last 15 years, there's one more thing that has changed, that's discipline. Okay? When you realize what risks are there and you realize how to deal with that risk, then there has to be a focused strategy of limiting yourself to that risk. Now, you will recall that we mentioned a little while back that we will do only risks which we understand, right? And this is where the importance of fund managers comes in, right? When you're disciplined about what risk you'll take and what risk you'll avoid. For example, we will not take execution risk. It's very easy to get tempted by a little bit higher returns, right? I mean, you have a project, there's a land owned by somebody else next door. Why don't we acquire that as well and expand the project? It will give us higher returns. But that's getting tempted, and that's compromising on the risk profile of your own investment, right?
Sure.
Certain risks have to be left to the developer, which they are best to take. I mean, those guys are the best to undertake execution. They know how to resolve issues if happens. As fund managers, we have to be content with what risk we can take and accordingly what return we'll get.
Got it.
So that's the discipline that is very important in this game.
Got it. Hemant, I'd like to wrap this up with an indication which we should have done at the start, but in the rest we'll do it now.
Sure.
What is the industry like currently of this? You had given us a beautiful idea of what private credit is in India and what you're trying to bring to the table. You've told us what you're bringing to the table. Tell us how the industry is currently as well around this, the size and the kind of number of years wherein this is now taking shape for Indian investors.
Infrastructure, you and I can feel it every day. We travel on roads, right? I mean, this is as big an opportunity, Neeraj, as it gets. Just to put some numbers for the viewers' benefit. In the last 15 years, if I can remember, the government has, commissioned projects worth 40 lakh crores. 20 lakh crores is under execution as of now, already for the next 2 to 3 years. And the government has a target to commission 120 lakh crores, Neeraj, in the next 5 to 7 years. That is the stated government policy.
Sure.
So you can understand the opportunity. 120 lakh crores will require 40 lakh crores of equity capital.
Sure.
That is what investors can participate in. Just to give you some context, and Abhishek and me were having a chat, our equity markets are approximately 3.5 lakh crores. 20% is retail participation, right? 70,000 crores. Infrastructure investing in the next 5 years is half that opportunity for investors. And this is an opportunity where there are large global funds already participating.
Open to Indian investors?
Yeah.
Not open to Indian
Not open.
investors.
Got it.
They are largely open to offshore investors. So there is offshore money already participating in a big way.
Got it.
I think what we at Neo are trying to do, we are trying to give the same opportunity that they are already, investing in. We want to give the same opportunity to our domestic investors in India.
Okay.
It's like, I keep saying, Neeraj, this is a moment where Indian investors have, done such great justice to this entire SIP revolution, where our markets are getting the benefits of our equities, right? Similarly, at Neo, we want our Indian customers to benefit from infrastructure, to benefit from private credit, because these are big asset classes. Our domestic money has to go into these productive asset classes.
Sure. Got it. Okay. Hemant, thank you so much for taking the time out and being with us. Lovely understanding this opportunity on the alternative bets.
Thank you, Neeraj. Pleasure always.
Likewise, and viewers, thanks for tuning to the yet another episode of the Alternative Bets.